we're going to be going over the differences in the tax benefits between crowdfunded website deals, syndications and private placements, and of course, REITs. And we're going to talk about why I don't like these things at all. Hey, if you're new to the channel, my name is Lane Kawoka. I own over $2 billion of real estate assets, multifamily, and the culmination of about 8,500 units or so. We educate people on investor education, especially for accredited investors. All right, what are the tax benefits in real estate in general? I'm going to be going over some of the basics here. So if you've owned a rental property, you already know that one of the great benefits of real estate is that you can deduct the price of the property, the improvement portion, not the land, over 27 years. My first rental property that I bought in 2009 was about $350,000 in Seattle, Washington. Now out there, the land is pretty valuable because it is a more desirable place to live. So at that point, the land, let's just call it half of the value of that $350,000. The remaining I was able to deduct over 27 years because the whole theory is the land doesn't degrade over time, but the building value, there's a sort of life to it. And per the guidance of the IRS, whether it's right or wrong, it is what it is. And what I try to do on this channel is teach you a little bit of the why, but more what do you do with this information? There's too many people out there, especially the CPA types that just kind of are in the weeds with this stuff and they don't understand the practical application. My job here is to really distill down what do the wealthy people need to know and what you should be doing to pay less taxes in this case. So going back to my little rental property in Seattle, I was able to deduct like half of the whole property over 27 years. If you do the math, I believe I was able to deduct maybe $5,000 to $6,000 a year, which exactly knocked out how much money I was making out of that rental property, effectively making all the profits tax-free. And this is one of the big reasons why I like real estate over all asset classes, because this ability to get these losses, or what we'll call passive activity losses, PALS for short, like your pal. And they truly are, because what these pals are able to do is knock out your passive income. Now, we're not going to get into the details on having it knock out your ordinary income. And there are ways to do that we'll talk about in other videos, or you can check out my tax page. But just specifically breaking down the whole crowdfunding websites, REITs, private equity, we've gone to the basics. 127 deducted over 27 years. Now, the cool thing about syndications, private placements, and REITs, especially if you're working with a professional operator, they're going to be doing different activities to optimize and maximize how much losses they're extracting through that real estate investing. And as a passive investor, whether you're in any of these three vehicles, you're going to be getting your fair share of those profits and losses, of course. Going back to that rental property, to do a cost segregation, maybe costs about $5,000 to $10,000. That's the price that we typically will pay for our large apartment deals that we're doing on behalf of our investors. But the cool thing is with current bonus depreciation and just regular straight line, more aggressive depreciation with commercial assets, a lot of times I'm able to take 1/3 of the whole building value in that first year, creating this huge surplus of, again, PALs, right? Your passive activity losses, which flow to passive investors. And then at that point, you can use it at your disposal to do whatever you want. Maybe you just want to knock out all your passive income or portion of it. Maybe you're doing some other things on your side and using it to knock out your ordinary income. Just to get the wheels turning there, things that we work with our investors is we take a look at your personal situation, which a lot of this is personal, right? It may make sense for you to drop your ordinary income to $300,000 or $200,000, or do what a lot of our more sophisticated investors do and drop their income down to nothing, therefore paying no taxes legally. This is exactly what the IRS wants us to do. Why? Because they put all these great tax incentives for us to invest in things like real estate. Portfolio income doesn't have this. And what is portfolio income? All the things that we tell people to try and stay away from, especially as they're building net worth. Stock, mutual funds, all the stuff that those financial planners sell. So now that we've gone over the basics of losses, passive losses, and how these bigger deals where there's a little bit more of an aggressive passive loss extraction, how does this compare in REITs, crowdfunding deals, and private placements and syndication? Generally, based on how much equity you're getting out with your equity share, you're going to get that equity share of the losses just like it with the profits. The devil is in the details. And what I will say there is not all deals are created the same. For example, if you invest a certain amount into a certain investor class, you may be credited or do a certain amount of the profits and a certain amount of the losses. But in some deals, which I see out there on the crowdfunding websites, you get a less percentage, maybe less returns or maybe less losses. So it's really hard to say. And this is, I think, where it gets really confusing. The way we do it is we don't cap the upside in how much investors make, as we see you guys as true passive investor partners, and you guys can get that fair share of the profits and the losses. But that may not be the case. Sometimes in certain deals, there may be what's called a special allocation, where I'm just going to use an extreme example. And I haven't seen deals like this, but they could give you your fair share of the gains per your pro rata contribution to how much the capital stack is. For example, if a capital raise was $10 million on a 500 unit property and you put in $1 million, your pro rata share would be 10% of that. And you would get 10% of all the profit. But there may be some kind of special allocation where you don't get 10%. Maybe somebody else, like the general partnership or maybe a different class of investors, get a bigger chunk of the losses. And I think this is where you really have to read the fine print with this stuff. We don't try to play these games, but I see this a lot in crowdfunding websites. And I've talked a lot about this in past videos, that usually the crowdfunding websites are deals that couldn't get funded. I personally don't use the crowdfunding websites to fill my deals. Why? Because we have a lot of great investors that trust us and refer their friends and come into our deals, and we fill it up in-house. I don't have to go to a crowdfunding website, act all desperate, and pay them a fortune to raise capital on my behalf. The truth is, when you look at these crowdfunding websites, you got to look at the deal. What is the deal? It may be a different part of a capital stack. And the way I explain this is, people are into shopping, probably are aware of the Coach Factory outlet store. Now, if you're somewhat sophisticated, you probably know that the products found in the Coach Factory outlet store are very different than what's in the real store, right? You know, the keychains, the purses, some of it looks the same, but there are some products made for that lower end consumer in the outlet store. So same thing here. There is some overlap, but from what I see, a lot of the crowdfunding website offerings are the second-hand capital stack that the other common equity investors that are directly with the syndicator, they're not getting. And the reason being is the crowdfunding websites are just less sophisticated investors. And a lot of times those investors will invest in sucker deals or sucker capital stacks. That's why I've always been, build your network, put some effort into this, join our club, educate yourself, but more importantly, build a network to get more directly connected with, like us, the operator. People work directly with us. They don't go through some secondhand broker dealer where they just dilute your shares and, again, potentially diluting how much tax benefits you're getting. I think this is a great segue into why I don't like REITs, what I've started talking about in the beginning. REITs are highly institutional type of investment products. When you hear that word institutional, you should be thinking of mutual funds, all the stuff that is sold by your financial planner. And that's why those things are called marketable securities, because broker dealers sell that. Look at from a whole. How else are these people making money? How else does Wall Street have these big buildings? It's all coming from all these little middlemen from the investment. When you invest in a syndication or private placement directly with the operator sponsor, you're effectively cutting out all these middlemen. The broker dealer that the crowdfunding website is, the layers of institutions and financial planners. You're investing directly with the source. So the difference between REITs and syndication private placements, they're investing in the same thing, but the big difference is how close are you to the source. By investing in REITs, you're buying an institutional product. It's no different than you buying a shirt off the rack of Nordstrom at a super high price, where you can get the same shirt, maybe even a better shirt, higher quality shirt for a fraction of the price by going through a different retailer or going, in a way, wholesale. If you're like me, you want to have a good deal and not have all these middlemen, these marketers take your returns. So you're going to want to go directly to the source. It's easier said than done. You're going to have to build your network with other purely passive investors. You're going to have to get off of YouTube and meet people. And this is why we have our events where we curate the audience with purely passive accredited investors. We have to get to know you. And that's why we say, hey, get on the phone with myself or my team. We want to get to know you. We also want to just help you out. It may not be a good fit, or you may want to go down a different road, because after all, this is all personal finance at the end of the day. Somebody getting $200,000 of passive losses may be beneficial to them, may not be beneficial to them, depending on where their adjusted gross income is and how their household income is set, whether it's all made by one income source, the husband or wife, the dual income type of arrangement. It's all personal. If you've seen some of the old coaching calls, you know exactly what I'm talking about. But that's it, guys. Again, just wanted to break down the different tax benefits between these three. I think this is important stuff for people to realize. If anything, you took one thing from this is try and get more directly to the investment, because you as the investor taking on the risk, you deserve all the upside. Don't let all these middlemen come in and take their splits and checks and referral fees and all throughout. I would also say, like, my whole style when I was going through this transition, I wanted to know the people who I was working with, build that relationship over time. And that's what we want to do with you guys coming in. So again, if you guys have any questions or comments, please put in the comment box below. If you guys have any other suggestions for videos, drop a comment. We'll see you guys next time. Bye.